My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Hey folks, welcome back. Today, I've got a really special treat today, something different. Our guest is Brett Swarts. He is a real estate entrepreneur who's got a real focus on helping us save money on taxes, especially on capital gains. And a lot of us, especially in the U.S., people that are investing in the U.S., are very accustomed to 1031 exchanges. Brett's got a different view on this and a different approach that he says will help save us a lot more in taxes. So Brett, welcome to the show. Great to have you.
Dave, grateful to be here. Thanks for having me.
Awesome. So Brett, tell us a little bit about, I know you kind of went through a painful experience when you first got into real estate, you and your clients doing 1031 exchanges. I think it was in 07, 08, that time frame. Can you tell us the not so pretty side of 1031 exchanges and the solution that you've come up with for that?
Yeah, so I think the biggest mistake people make when they're doing a 1031 exchange is the equal or greater debt piece, right? It's equal or greater value, which means it's also equal or greater debt. And so you have to replace that debt and you have to sell. Typically, when you sell, you need to buy within 45 to 180 days. And we call that the shotgun wedding, right? Oftentimes you're running out with your hair on fire and you're buying deals that you maybe or wouldn't ever have purchased without the pressure of the capital gains tax. And the capital gains tax is 20, 30, 40%, 50% of your proceeds. Just depends on the state you're in, depreciation recapture, all these different things. And the problem with the 1031 exchange is it puts the real estate entrepreneur in a box. And guess what we don't like to be, Dave? We don't like to be put in a box, right? No. Especially when we feel like the leverage is with the seller and we're the buyer. And the leverage is with the banks, and we have these higher interest rates. And, we're seeing it happen right now. People are losing half or all of their wealth because they overpaid in the last couple of years. And guess what? This happened in the 06, 05 market, and then 07 and 08 hit. And so that's what happened. And I'm seeing
a little bit of deja vu for you.
Yeah, deja vu. Obviously not as bad as the 08 one, but it's just sad to see that we as entrepreneurs want to make great decisions. And we want to be able to diversify. I love real estate. I love a 1031 when it makes sense. But I also like the ability to buy when I want to buy. And I'll give you an example. We did a $13 million exit for a real estate client selling a car wash, San Diego. Beautiful property, basis $4 million, massive gain. And guess what? He's a real estate developer. That's what he does. He buys the land for $500,000, puts $3.5 million to build the whole car wash. Boom, value jumps to about $13.5 million. Wow. So he has this huge gain, and we felt we were at the height of the market. It was pretty obvious. Rates were still really low. Everything was still going pretty gangbusters. And so we're like, do we really want to buy a $13.5 million property? No. He didn't want to buy right there, right? Why? Because he wants to buy land for $500,000, put $3.5 million into it, and then go sell it for $13.5 million. So it didn't even
he wants to get his $9 million or whatever in profit and do something with it.
Yes, sir. Yes, sir. Yes, sir. So the challenge with the traditional developers, they have to pay capital gains tax on that because you can't 1031 into something that's not equal or greater value. So it's this whole thing. So we solved that, and so instead we set up an installment sale with a trust that allowed him to take a seller carryback note from a trust, and the trust ultimately sold it to the buyer. And the funds went into Charles Schwab, all tax deferred. And guess where he invested a lot of the funds? Passive real estate debt deals from Schwab to all these passive and stuff that was paying 6 and 10%. He put a lot of it into Bitcoin at 40,000 a coin. Okay. Now it's over 120,000 a coin, right? Put it into some diversified stocks, which he's not a big stock guy, but he diversified, and he put a lot of it in most of it actually real estate debt, just paying 10%, really steady, 55% LTV. He diversified all of this wealth, deferred all of the tax, and then we waited for the market, and we're seeing the market go down, and we're starting to buy into other equity positions at a lower basis. And that's the whole point. It's really simple. Sell high, buy low, using a strategy that gives you the ability to make great decisions versus the 1031 exchange, which often it just puts you in a box.
So let's unwrap that a little bit more in depth. And I know you do this all day long, but humor me and some of the other folks that this is like brand new for. So walk me through step by step exactly how a deferred sales trust works, if you don't mind, Brett.
Yeah, step one, you set up a trust. And so say Dave is the seller, right? And step two, we put the name of the trust or even just the option for you to use the trust inside of the contract. So you have a buyer lined up, and let's do another deal that we recently did. We did an $8 million sale in Massachusetts for a automotive business seller, okay? And so it's $8 million deal. They have zero basis, massive tax. And so before the sale of that asset, we assign the interest to the trust, and this trust issued a promissory note to the seller, right? And it's a simultaneous close, so it doesn't happen until the close of escrow happens. But when the smoke clears, the seller has a promissory note, right? 8 million. And the buyer took title. They're gone. They get the business. And the cash from the buyer is sitting in Charles Schwab. Okay. And an interest rate we put on the note, 6, 7, 8, 9, or 10%, just depending on the risk tolerance of the seller. In the scenario you're Dave, let's say it's 9%, and you've got an $8 million note at 9%. And then we say, well, would you like to invest the funds? And you say S&P 500, or I want to put into this real estate deal I have. I want to diversify into this real estate debt fund. It's totally open source, but the reason it's tax deferred, Dave, is because you did a seller carryback. This is known as IRC 453, part of the U.S. tax code, where you, Dave, to the extent you don't receive any payment at close of escrow, you're in a deferral state. You became the bank, right? You're owed the money, right? And that's the key. That's how it works.
Interesting. So how long has this been around for, Brett? Is this something relatively new, or has it been around for quite a while?
This strategy, known as the Deferred Sales Trust, has been around for over 28 years. It's been thousands of transactions, billions and billions and billions of assets sold using it. And really the most important stats is about 2.5 dozen audits. They're all no change, okay? So we've never had a single change in the audits. We have a perfect legal track record. It's never been on an IRS watch list. It's never been on what's called the Dirty Dozen. And it works again for businesses, Bitcoin, real estate, stock, primary homes, luxury homes, any asset of any kind, as long as it's subject to U.S. capital gains tax. Works for artwork, collectibles, music rights, you name it, we've done it. It works for really anything. Here's the key. You need to have at least $1 million net proceeds, $1 million gain. And if so, again, you just go to our website, capitalgainstaxers.com, and you can schedule time to kind of go through it.
Okay. Well, I was going to ask, that was another question. What's kind of the minimum and that sort of thing? So for smaller deals, doesn't really make sense.
Correct.
This is for $1 million plus gains kind of thing.
Yes, sir.
How did you first kind of stumble across this or discover this, Brett?
Yeah, it was 2006. Things were going great. Marcus and Millichap, lots of 1031s, high fives, people making the money. And then all of a sudden, middle of 07 and then 08, everything falls apart. And I saw friends from clients lose half or all of their wealth. And I was newly married, baby on the way, trying to figure this whole, marriage thing out and real estate thing. And I was working at Marcus and Millichap, and we had one of those things called a lunch and learns, where I started to learn about this thing. But at the same time, I was running out of money. So I did what every real estate wannabe does, entrepreneur does. You get a side hustle. My side hustle was Cheesecake Factory. Nights and weekends, I worked nights and weekends to sell, I call avocado egg rolls to keep the lights on. And then by day, I'd work at Marcus and Millichap to help my clients, renegotiate their property taxes, figure out a way to keep their tenants in their property, and ultimately just hold on to their properties because everything had kind of plummeted. And during this time, we learned about this strategy that could have avoided the pain of the 1031. And I'm going, wow, if there's a way to eliminate the need for the 1031 exchange, I want to know about it, right? Like most people said, it's too good to be true. We thought we would have known about it. We felt like we were the Navy SEALs of investment real estate brokerage, all yada yada, all that stuff. But we got humbled really fast, and so did our clients. And so I said, look, if what he's saying is true, tax attorney CPA who created this, my business partner, then man, he's got Netflix. Now Netflix wasn't around at that time, right? Yeah. But we're stuck in Blockbuster. Yeah. Like what is this disconnect between these worlds, right? So I grew up as a real estate family development in the Bay Area of California. And I just saw the devastation of people overpaying for properties or not having good options to get flexibility with their capital and liquidity, diversification, liquidity, debt freedom. And you start to check the boxes of what people really want, Dave. And what we found is people really want truly passive income. We call that no shoes, no shirt, no problem. You're Kenny Chesney playing the guitar on the beach, and you have durable 10, 20, 30, 50,000 of income coming in every month, and you don't have to really think about it, and you don't have to trade any of your time for it. And that's basically why I love the Deferred Sales Trust, because it unlocks what we've been looking for all along, which is the fourth quadrant of the Robert C. Kiyosaki, quadrant. Most people get stuck in, the two quadrants, the upper right or the bottom left. And I'm going, this is the key. They have the real estate, they have the wealth, they have the millions, but they don't have the freedom of their time. So if this unlocks it, now it's more like Netflix. You don't have to return it in 3 days. You don't have to, drive in the snow. There's some ongoing fees. You work with us as the trustee, right? So there's some stuff there. But it's not the restrictive, blockbuster 45, 180, 1031 exchange. And so that's the big secret. If you can be a real estate entrepreneur, you can be passive or you can be active. You can go into stocks, you can go into Bitcoin, you can go into real estate, you can go into crypto, you can develop, you can go into real estate debt. You can basically do whatever you want investment or business purpose wise at any time. Why would you ever do a 1031 ever again? And that's exactly right. You wouldn't do a 1031. But I think a lot of real estate people, to kind of throw up another objection, why isn't everybody doing it? They haven't heard the podcast, right? Your real estate agent probably doesn't want you to do it. They want to keep you in a 1031 so they can get paid. I'm a real estate broker myself. I sold over $500 million of real estate, right? So I get it, right? I get it. And that's kind of their world. That's also all they kind of know or want to know. And that's the key. But what matters most to you, Dave, right? Or whoever's listening to this, and that's what you got to get really clear on. And then say, okay, if what matters most to me is truly passive income, and I have the wealth and I can turn my 3 to 5% ROE, which is what most people find us. They have 3 to 5% ROE, return on equity. We move them to 8, 9, and 10%. Sometimes we double, sometimes we triple their cash on cash return, and their life changes because now they can sell that asset now, have the truly passive income, and then they have all this extra time. So that's the beauty of what we can provide for everybody.
Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com. So a couple of questions here, Brett. First one's kind of a dumb one, but when does the penny drop? Like it's tax deferred. At what point is Uncle Sam getting his pound of flesh, and how?
Yeah, when you take principal, any principal of the sale, you pay cap gains tax based upon your basis and the return, right? So, but most of our clients never dip into the principal. Most just live off the interest payments, and when you take interest, you pay ordinary income tax, right? So that is one of the downsides. You pay it in the year which you take it. Some of our clients will delay for a couple of years any interest payments, and they're paying no income tax for those first couple of years, and no cap gains tax either on those. And then the next thing would be you can take partial interest payments, and so we work with clients, when we did an $8 million deal in Palo Alto, he moved to Nevada, right? Established residency, and they start taking some payments. We have clients that New York or New Jersey and Massachusetts, and they're selling, deferring some tax, and they're moving and getting established residency in Florida. And so there's some creative ways. And once you establish residency in that state, the income in which you receive is taxed at that state cap gains tax, or not cap gains tax, but ordinary income tax. The cap gains will always have the nexus in the state in which you sold. So those are some of the things to consider. But honestly, you can kick the can for as long as you want. Your kids can step into your shoes and you can keep kicking the can. There's no stepped up basis because you can't step up a basis on a promissory note. But yeah, back to what are you looking to do? You're like, hey, I want to buy real estate on my own time. I want to diversify. I don't want to have to go into debt. I can still go into debt and buy more deals when I want to, but I don't have to in the same 45, 180. And you go, wow, all those things are great. And so what are the downsides? There's really 3 that really come to play, right? Number one,
that was the next question I was going to ask. It sounds all great,
right? It sounds too good to be true. Why does my CPA know about it? Why didn't I get told about it? You're like, why am I just hearing this on the podcast? And I go, look, I get it. I was the same place in 2009 when I heard about it. And it took a while for me to, learn about it and study it and understand it. So take your time as you study it. But understand that it's just an installment sale, seller carryback with the trust. So it's actually really simple. There's been thousands of transactions, billions and billions of assets sold using it, over 2.5 dozen no change audits. So it's a perfect legal track record, all 50 states, any asset you can imagine. So the legality part is there. It's never been on an IRS watch list, never been on a dirty dozen. It's literally batting 1,000. Okay, perfect. So that's the legal part. Let's put that to the side for a second. Number 2 is the trustee. That's us. We're the third party unrelated trustee. So you have to give up some control, Dave, right? You can't have all the controls because then you just sold it to yourself and it's taxable. So we're like a third party qualified intermediary. We're kind of like that. Okay. Where the funds, we manage these individual trusts. And in this scenario, if you did it, Dave, it would just be for you and your spouse if you're married, right? And the funds are at Charles Schwab, but it has its own tax return, right? Nothing moves at your approval or your signature. So there's all these kind of controls in place, but you're the sole creditor, right? You're owed the money plus a return, and so that's the main thing, right? You get a promissory note to for the legal document there to pay you back over time. So there's some controls in place that help with that, but you have to give up some control. I have to approve of the investments, and so do you. So people have to get comfortable with that. Now the third one is fees. Like fees are not inexpensive, right? In fact, 1031 exchange is maybe $1,000 or $2,000, right? It's a commodity, right? You can do them across 5,000 QI companies across the country. Our strategy is very specialized. I'm one of the few in the whole country who's done regular 1031, Delaware Statutory Trust, and a Deferred Sales Trust. By the way, you see those are both DSTs. They get confused sometimes, and people go, "Oh, I already know about a DST." No, you know about a Delaware 1031, Delaware Statutory Trust. That's another 1031. That's more like Hollywood video. It's just another form of 1031. Ours is a Deferred Sales Trust where it works for any asset of any kind. And then also all the timing. So back to the fees, we're about 1.5% to set it up, one-time fee, and then about 1.5% to 2% on a recurring fee for the assets under management. So we're more expensive. It's continual fees. But guess what, Dave? If your most important thing to you is moving from $10,000 a month to $20,000 a month passive income, do you care if you're paying 1.5% to 2%? No. You're like, I doubled my cash on cash return, right? Second thing is, guess what? If you have a property management, guess what you're paying them? 4 or 5 or 6% of your revenue. Most people forget about that, right? And you go, and that's only returning you, let's say 10,000 a month, or we're going to give you 20,000 a month. And then they go, oh yeah, you're right. So
basically it's kind of like it's a structure that's set up. You're, for lack of a better term, like a financial advisor, helping the person determine what they're going to be investing in. There's fees and everything that's involved with that. Just like it would be if you were a regular client of Charles Schwab kind of idea, right? So that's basically the downside, if I'm understanding correctly.
Yes, but let me give you a little nuance to that.
Sure.
We consider ourselves real estate investment advisors. Okay, so most of our real estate clients, guess what? They made their money in real estate, or if they're entrepreneurs, they really like real estate. Most of their wealth they made in real estate, which is where we made our wealth. They're not necessarily big on the stock market. By the way, we think we should have a balanced, diversified portfolio within the Deferred Sales Trust, and we can hire and bring in the top financial advisors to help with that. You might have yours, Dave, that you want to bring in to balance the team out. We're going to build a team. We're going to build like a mini fractional family office to help you execute this. It just kind of depends on where and how you want to invest the funds and who you want on the team. Right. Okay, but we're not securities advisors, right? And so, but we can bring that securities team in. But I would say the majority of our clients love us because we're great at real estate, mobile home parks, multifamily, real estate debt, industrial properties. Those are some of our favorites. And we partner and strategically align with some of the best in the entire country. And then we diversify into passive real estate deals, right? And also we help you understand how you can use this to actively partner with you. Back to the $13 million deal in San Diego, guess what? They're looking for land right now. To partner, and the trust can partner with them to buy the land, to develop the car wash, and do it all over again, all tax deferred. So we're really good at structuring how the real estate entrepreneur can continue to be an entrepreneur, or the business person who's listening to this to do a business venture. We're the first to do this with Bitcoin. They exited $5 million of Bitcoin, deferred the tax, and use a big portion of it to fund a new business venture, like a Khan Academy, online education academy. So it's not a one size fits all. It's really like, how do we customize the team to help you execute what you really want? That's our superpower.
Awesome, Brett. Well, as we're kind of wrapping up the conversation, I know you've got a book about this, and you mentioned that, hey, you know what? Do your due diligence, find out a little bit more, study a bit, all that kind of good stuff. Tell me a little bit about the book. Tell me how people can connect with you. I think you've got a podcast all about this kind of great stuff. Tell us a little bit about that.
Yes. So the book is called Building a Capital Gains Tax Exit Plan. Nice. You can find it by going to capitalgainstaxsolutions.com. We have Kevin Harrington from Shark Tank in the book. We have Tony Robbins, CPA, in the book, and some other really smart folks. And then I get a number of chapters. But basically, it's my entire story of basically zero to having this knowledge. I try to condense it into the book. to help you build an ideal wealth plan when exiting any asset of any kind for yourself or for your clients. So really, you're a real estate agent or a real estate investor, financial advisor, business broker, M&A advisor, CPA. You want to pick up the book and you want to just find out the secrets, right? I try to give them all away in here so that your clients can multiply their freedom and their wealth and make a bigger impact. If you want to learn about, or you have a live deal, because we do need to set this up prior to the close of escrow, or you want to access our best 1031 exit plan, which gives you a regular 1031 and our strategy as a backup plan, you can go to capitalgainstaxsolutions.com, schedule a no-cost consultation. You just need to have a deal size of, again, $1 million or better, and then that will get you qualified to be able to speak with us at no cost, no obligation.
Awesome. Brett, thank you very much. I appreciate the explanation. Also, you know what? Hats off to you for dumbing it down for some of us dum-dums. I love the whole comparison between Blockbuster and Netflix. That really very, very well done. So yeah, that's great. Thanks for sharing how it all works.
Thank you for having me. I appreciate it.
All right, everybody, take care, and we will see you on the next one. Hey there, I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewsyou.com.